Hello, I'm David Chaston with 989, brought to you by Interest.co.nz. This week at everything you need to know in 90 seconds at 9 o'clock, with news that some trade results are at odds with trade policies. But first, the latest survey of American consumer sentiment shows it's slipping again, but from a relatively high level and still historically high. June data out in the US shows that terms of trade improving. Import prices are up 4.3% year on year, while export prices are up 5.3%. Meanwhile, their trade deficit with China grew. The June Chinese data shows it at $29 billion for goods, and it may get even larger as US importers try to front-run their requirements ahead of expanded tariffs the Americans have announced. But overall, China's goods trade surplus shrank because it shrank with nearly everyone else, and part of that was moderating demand from imports. Chinese exports rose 11.3% year on year in US dollars terms to reach $217 billion in June, while imports increased 14.1%, down from 26% in May. One perhaps surprising consequence of the US tariff action is that a number of car companies are swiftly moving to set up expanded manufacturing in China. Another consequence is that the Chinese are slowing their financial market reform in the face of the trade tariff risks. An example is the earlier claimed policy moved to slow the growth in corporate debt. Instead, they're letting it run as stimulus support. Bank lending was up almost 13% year on year in June. China's $1.4 trillion sovereign wealth fund is seeking the authority to invest in their domestic stock and bond markets for the first time. It wants to end restrictions on its mandate following government moves to open up the financial markets. All these Chinese actions may be cover for what is in fact slowing growth. That will become clearer in the coming week. And there are rate rises around the world. First it was Canada who raised their official rate by 25 basis points. Pakistan increased theirs by 100 basis points to 7.5% on rising inflation. And Israel's looked like it's next, also pressed by a rise in inflation. Israel currently has a 0% policy rate, actually 0.1%. US Treasury 10-year yield weakened in New York at market close to under 2.83% and down 2 basis points. Their 2-10 curve keeps going down, now under 25 basis points. At this rate, inversion could come quicker than markets expect, and when that realization dawns, it may be self-fulfilling. Bond markets seem to be signaling an early end to the program of US Fed rate hikes. Gold is weaker and now at $1,241 an ounce. And US oil prices are up today from yesterday and now just over $71 a barrel. The Brent benchmark is now just over $75 a barrel. And the Kiwi dollar is starting the week at almost exactly where it was at this time last week, at 67.6 US cents. On the cross rates, however, we're lower at 91 Aussie cents, and that is its lowest level in 6 months, and at 57.8 euro cents. That puts the TWI at 71 and its lowest level in 10 days. I'm David Chaston. That was 90 at 9, brought to you by Interest.co.nz.